Okay, it is high noon, so I'm gonna welcome everyone to our webinar today. I am Joe Gallemore, Director of Investment Management here at Argent Bridge. And today we are discussing with our good friend Larry Redell from the St. James Investment Company. We're going to talk about the St. James strategy and their take on value investing. We're going to talk about a few topics that are top of mind, especially in the media, and then how St. James as a defensive strategy kind of approaches the current environment we're in, because there's certainly plenty to talk about with all the headlines and global events and the state of the U.S. economy and all that. So before we get started, I want to mention that this session is being recorded. And we will have available later on our website and our YouTube channel. And if any of the audience members would like to ask a question, there is a Q&A widget function down at the bottom of your webinar window. So if you hover over that, see Q&A, you can click on that. It'll pull up a window. You can ask a question directly to me, and we will incorporate those as we go along. So please ask questions. We encourage everyone to participate, and no question is a bad one. So we encourage the conversation. So today we are very pleased to have with us Larry Redell from the St. James Investment Company. Larry's actually a longtime friend of everyone on the Argent Bridge team. Larry's a partner at St. James, which is based down in Dallas, Texas. He is involved in the portfolio management and is in charge of all the outward communication regarding the select value strategy and the absolute core equity strategy. They're the same strategy. Larry also oversees all the operations down there at St. James. He has a degree in finance from University of Texas and an MBA from UNC down at Chapel Hill. So Larry, I hope you're as excited as I am as for the success of Sam Howell on my Washington Commanders, who's I think the only UNC grad in the NFL, but I'm probably wrong.
Yeah, I'm torn because I'm a Cowboys fan and I'll actually be going to that game on Thanksgiving.
Thanksgiving, wonderful.
But
we'll look for you.
It's great to see a Tar Heel do well.
Yeah. But Larry, thank you for being with us today. We're really excited to hear St. James's take on everything going on. So what I thought we might do is we'll hit a couple of the hot topics that everyone's hearing a lot about today, and then we'll talk about the strategy some, and then we'll end with some general investing concepts that everyone can benefit hearing from.
Right.
All right, so to start, I think the theme of 2022 and then 2023 was inflation and then Fed action. Basically a decade of very low interest rates for one reason or another, and then pandemic shutdown. That ignited a chain of events which led to very high inflation that happened pretty fast, and then that was subsequently met with historically aggressive Fed action. They raised interest rates, and not to some unprecedented level, but the speed at which they did it was almost unprecedented. It was a very aggressive time frame in which the Fed had to raise interest rates. So that has led to a lot of price dislocation, both in bonds and stocks. But us as investors, we just see that happening, and not everyone's sure why. So I was hoping, could you help us explain, how do higher interest rates affect stocks specifically?
Sure. Well, and thanks again for having us. We view investing, which is different than speculating. Investing is just, in our mind, you're buying a security, you're buying a stream of cash flows. And that could be a stock or a bond or several different kind of financial instruments. And the way you apply rates or cost of capital depends what you're willing to pay for that that stream of cash flows. And so, and that's very obvious finance 101, but what's happened over the last decade has been an enormous perversion, because let's remember, in this country, we drove rates essentially to zero. And actually in Europe, they drove rates below zero. I mean, the most egregious example of what went on, which violates all the laws of finance, is not only did government bonds go less than zero, there were $1.5 trillion of European corporate bonds. Companies like Diageo and Sanofi that we owned actually borrowed money at rates below zero, so they got paid for putting that debt on the balance sheet. So that has been an enormous perversion to asset prices. On top of that, you had a Fed balance sheet gradually since the global financial crisis, and then it really took off during COVID, where we're splashing around monetary money. Obviously, we splashed around a lot of fiscal money. We had rates near zero, and lo and behold, we come to find out, Joe, that the laws of finance actually do apply.
Right.
And we did wind up with inflation that was not transitory.
Yep.
So driving to your question, you know, they used to say when rates were zero, you bought stocks because there was no alternative. You couldn't own a bond, wouldn't pay you anything because of this artificial suppression by central banks. Well, now there is an alternative.
Yeah.
A short-term treasury will pay you 5%, and that should and does have an effect on valuations. But to your point, and I'll give a brief example and we can drill into it, not all companies are affected the same way. If you think about quote unquote disruptors or companies that cash flows are far, far in the future, well, their valuation sinks much, much more. But companies that have good cash flow today and you can buy at a reasonable valuation, you're still willing to pay. And in fact, there's some areas of the market, one of which we would point out, like insurance. All of our financials right now are essentially insurance companies because we're dubious on the banks and have been for a while, as you know. But insurance, there's a reason billionaires love insurance companies, most notably Warren Buffett. You have float. And for years and years, that float was earning very, very little because rates were suppressed. Well, now, if you can find the right insurers that do thoughtful underwriting, they're making a lot of money on that float. So there are areas of the market that are candidly unloved that are actually in some ways beneficiaries of the return of normalized rates. And let me end with that. A lot of my friends, especially in real estate, would say, well, when rates go back down. Yeah. But I think it's an important point to say that what we have now is far closer to historical norms, right, than what we've had over the last decade. And we suspect that that will continue to create disruptions in the capital markets. Yeah.
Okay. Wow. Very good example of insurance companies. I was going to ask if any stocks benefit from higher interest rates, and I think financials are the key beneficiaries of those.
So. Not all financials.
Not all financials.
And I would say banking's a great business, but because of the structure and some of the perversions over the last decade, it has a lot of known and unknown risks versus the example I gave, insurance, I think is a great place to look and candidly pretty unloved, which is also makes valuations attractive.
Yeah. Excellent. Thank you. So we at Argent Bridge a lot this year have highlighted that the S&P 500 index, which is the most common index, most commonly cited index, that's had very narrow breadth. And for those on the webinar, what I mean by that is that the performance of this index, when you turn on your TV, see CNBC saying the S&P 500 is up 15% this year, but nothing else is up that much. Why? It's because only a few stocks in that index are performing really well. The rest of the stocks are not performing really well. And all the other asset classes are not that select group of stocks. So the media has dubbed this the Magnificent Seven stocks, very tech heavy. Those names are Apple, Amazon, Microsoft, Nvidia, which makes semiconductor chips in just about everything these days, Tesla, Google, and Meta, or else Facebook. So that breadth has been extremely narrow, and we've spent a lot of time highlighting that all the other indexes not doing as hot because there are headwinds in the economy. Yet the S&P 500 is up, north of 14% right now. Can you help us put those 7 stocks in perspective when you see it concentration like this, and why they're carrying it, and whether that's right, wrong, or otherwise?
Well, it's well said, and it harkens back to, and we were in business during this time, during the internet bubble of the end of the 90s. It wasn't only internet stocks that did well. You had a small number of mega caps, AIG, Dell Computer, Walmart, that were trading at absurdly high valuations. And there was a whole lot of stuff, great quality companies that were left behind. But to put a little more meat on what you're talking about, I'm looking at my screen right now. The S&P 500 is up 14.4% year to date, which is a market cap weight index, as you know.
Which means
the S&P 500
companies in that index get the largest weight.
Right. The S&P 500 equal weight is down 1% year to date.
That's a spread of
same companies, but not equal weighted. The largest company gets equal weight. It's the smallest weight. And it tells you all you need to know. For most companies, we are in a bear market, reacting to the dynamics that you and I just talked about, with rates going up dramatically and the Fed stopping the spigots, so to speak, with monetary policy. And those 7 companies, they command, and on the market weight index, 30% of the S&P 500. So there's 500 companies, actually 505. 7 are 30. And their price to sales, if we're just looking at basic valuation, is 10.6 times. They are very, very expensive. And so when we step back, we didn't, just for a second on St. James, this is our only strategy, and this is what my business partner Robert and I do with our money. So this is very much, hey, we're not trying to do what's marketable per se. What we're trying to do is just buy cash flows cheaply, which we think is the hallmark of a enduring portfolio in valuation. We're saying, forget about those 7, because they're great companies, but they're really, really expensive. They're priced for perfection, we would argue. And some, like Apple, are going through negative growth, yet the valuation. We're finding all kinds of unloved opportunities. And the way I would characterize that is, if you think about the Magnificent Seven, which you just rattled off, Joe, they're really about people's wants, right? I mean, we're going to go to the metaverse and we're going to watch Netflix, maybe in our Tesla. I don't know, but they're somewhat indulgent. And then when you think about people's needs, when we think about not only insurance, but energy, materials, agriculture, not only are these companies inexpensive and very, very high quality, but there's supply issues we have ignored for a variety of reasons, some of them political. We have ignored opportunities for cheap, abundant energy. The world is changing, where agriculture and material chains are being ripped up. And so we take no delight in those disruptions. But as an investor, the companies that are working to solve those disruptions, that are leaders in those areas, are really, really attractive. And by the way, when you go back to the collapse of the internet bubble, there were similar opportunities if you were willing to be different than the herd.
Yeah, interesting. I like that. Yeah, and you're speaking to a kind of a macroeconomic dynamic that, you know, might be worrisome on a social scale, but is actually a tailwind for some of those stocks that are playing in that space. Interesting. So
Absolutely.
yeah, great segue. I want to let's shift towards talking about strategies specifically a little bit.
Okay.
So if you could give us just an introduction to to St. James's philosophy and just a short, I don't know, description of the process about how you guys look at stocks, what you decide to, you know, put in the portfolio when you're looking at buying a stock, what are the biggest determinants, and what is there an overarching goal of the strategy?
Sure.
Yeah.
Well, as you know, we have close to now a 25-year track record. We started when we were pretty young guys. And what we've been able to do is limit downside participation. And so by just hitting singles, as we would say, and not taking the big hit, you compound really, really effectively. And we feel like, you know, you can make investing really, really complicated, or you can make it really, really easy. And for us, I alluded to it, we're trying to buy cash flows cheaply. And so if you're going to be in equities and buy cash flows cheaply first, you got to find a business model that has proven delivering cash flows, so it's easy to project in the future. And equally as importantly, you got to find management that has a really thoughtful approach to balance sheet risk. So we don't want companies that don't have debt easily covered by operational cash flow, and management that are good allocators of capital that create return on invested capital. So people ask, so it's to us, it's real simple. We'll buy a large cap domestic, a large cap abroad. It could be what people call a growth company. At one point, we owned Microsoft when it was $18 coming out of 2009. We just want, if we're going to do 7 years of cash flow, we want to know that that business model can give us those 7 years of cash flow.
Yeah.
And if we can buy those cash flows cheaply, I don't care if the stock price goes up and down. What we care about is those cash flows are coming in, because that's risk, right?
Mm-hmm.
So it's a very concentrated portfolio, because we don't want our 50th best idea.
Yeah.
We want to buy great companies at the right price. And if those cash flows come in, we don't think we're taking risk. Yeah, stocks might go up and down in the short term because market is myopic and it's full of behaviors. But its risk is not, let's own 200 stocks and see what sticks. Risk is, did those cash flows come in? And do I have a margin of safety for the valuation of that company? So that's how we think about things. And it's been really interesting. The strategy did exceedingly well from 2000. You know, we started in 99, but just take Jan 1, 2000 to December 31st, 2010. The S&P was down 0.56% a year. We were up 7.5%. All right.
Per year.
And now you go into this era after the great financial crisis where they throw money at everything. The market's up 13% a year. We're up about 9%.
Good.
We don't apologize for that, but everyone doesn't get excited about what we're doing anymore.
Right.
And yet now this return of real rates, we think, is ushering in a era of price discovery where we feel like thoughtful investing will be rewarded once again.
Excellent. Okay. And that while you were explaining, you mentioned a concentrated portfolio. So that, to me, that makes my mind think about diversification And, we preach a lot about being diversified on your asset allocation, but within the strategy, how does St. James approach diversification? Historically in the strategy, you mentioned different market caps. We've seen stocks from different geographies. We've even seen different asset classes. It's all gold bullion, I think, at one point, or a gold ETF. I think there are gold miners in there right now. So how are you guys approaching diversification? Is it by sector? Is there any macro input into it, or is it literally just looking at?
We have some very loose guidelines, because again, what we want to do is own great compounders and own them at the right price. And we can get very, very deliberate. As you know, we own over 10% position in Berkshire, not because of his public portfolio.
Yeah.
But we believe the private enterprise of Berkshire is incredibly undervalued. In the past, we went really a high position in Johnson & Johnson. In 2016, they had a recall issue. Or it might have been even 2012, 13, I think, now I think about it. And you're talking about the global leader in every category that they offer. And you're talking about one little segment, but people kind of freaked out, which is the nature of the markets. We went right to 10%. So now, when we owned something that's riskier, like it was France Telecom, it's now Orange, we thought it was 50% undervalued, but we never owned more than 3% because there was debt. It was partially owned by the French government, etc. So when we're putting things together, we're absolutely looking at how much of a margin of safety do we have versus our conservative belief of fair value. But we're also thinking in terms of those cash flows. We need to make sure those cash flows come in, and we'll size our positions accordingly. But other than that, 20 positions, we think is fine if you know what you own. And to that point, Joe, if I'm not extending this, a lot of managers will say, okay, if I'm down 20%, I'm going to sell. And not to be overly provocative, but we would suggest those managers don't know what they own. Yeah. Right? I mean, we don't, if the stock price goes down 20%, we will certainly go back and say, did we miss something? I mean, we've written out our thesis, we're looking at it. And if we didn't, we'll buy more, because we believe the market is myopic and full of a lot of greed and fear. And we try to exploit that as long-term investors.
Excellent. Yeah. And within the portfolio, cash has always been a significant element. Clients, we've fielded the question, why is St. James owning, 10%, 15, 20% cash right now? Can you talk about what kind of role cash plays in your strategy, and actually why that might be an advantage afforded to clients?
So it's funny. The value managers that have survived a lot of different environments would all espouse cash. Okay. Most famous being Warren Buffett. But
even if they don't want to admit it.
Howard Marks, Jeremy Grant. I've got a list for you.
Yeah.
Okay? And here's the reason, and this is why it's misunderstood. Entry price is what determines return. And so we only have 20 positions. We can be incredibly deliberate. Okay. But that optionality has served us well, admittedly better when rates were normal than in the last 12 years when everyone just wants quote unquote beta, right? Yeah. Market's going up, cash is paying zero.
Yep.
I get it. But now that we're getting paid 5% on our cash, we've tried to be really proactive with that cash without taking risks to get clients into things that pay. And the optionality in a market, I mean, we saw it last year. I mean, when the structure of the market cracks for whatever crazy reason, we've got a wish list. We know what we want to buy. We know what we want to add to, and we've got the powder to do it. That we feel is very, very powerful to us generating a lot of alpha.
Yeah, long term especially. So taking a peek not too far in the past, in 2022,
Yeah.
the market is down, I think around 18, my memory serves me correct. But the select value strategy, that was flat. That was
Right.
excellent outperformance. What about the strategy enabled it to achieve that?
Well, it's kind of what we're talking about. We owned stuff that no one liked at the time because they were obsessed with a few expensive market darlings. And certainly our energy allocation was really helpful. But precious metals, we expressed that through an excellent miner called Agnico, and we've recently bought Franco-Nevada, which is a streamer. But despite rates going way up, precious metals hung in there really, really well. And we think there's reasons for that we can get into. So being different was really helpful. We are admittedly surprised. I will tell you, around here, there was actually some enthusiasm because the market in our mind was starting to normalize due to higher rates. And we thought we would be able to continue to exploit that. The Magnificent Seven coming roaring back. I wouldn't speculate. I mean, it could be just a lot of knee-jerk reaction. Certainly, they're good companies. The AI narrative was really helpful to a few of them, obviously, and especially one. But you know, there are short-term optics, and we're doing well versus like the Russell 1000 value, which admittedly no one cares about. But versus the S&P, we think this strategy will do well because we think, you know, kind of extending your point, inflation is more persistent than people think. And we don't try to prognosticate out here, but yeah, the rate of inflation is declining, but that doesn't mean there's not inflation. And when you're reshoring labor, you've got supply issues when it comes to materials and energy. You got rates that will likely be a lot higher for longer than people expect. It will bring about a continued price discovery, although it may continue to be bumpy.
And that's an interesting point. So I want to ask you about, continue to be bumpy. We've mentioned on a couple of our publications that we hear a lot about cycles. We just got done with a rate hiking cycle. We pointed out that recessions are kind of the resetting of the economic cycle. There's credit cycles that go to a market cycle. We've made it a point to point out that the stock market is not the economy and vice versa. So it's real easy to attach those two, but it's very important to fight that. So a market cycle is different from an economic cycle. But what is a market cycle? If you could kind of describe that for us, and then talk about how St. James, you know, how this process guides the strategy through a market cycle, and you know how that relates to clients' emotions. Because at the bottom of any cycle, it's tough. Well, there's at the height of any cycle, it feels like everything's going to be great forever.
Right. I mean, there's so much to that, and I guess I want to. When it comes to the economic cycle, here's the thing that I don't know why it's more focused on is zero rates has invited an enormous amount of debt in every level of society, right? Now, some corporations, they were smart enough to push their debt way out, but the U.S. government didn't do so. And consumers are really candidly in a bad shape. So
through credit card debt, right?
yeah, I don't have a roadmap for how this winds up, but
Right.
Within the economic cycle, those are typically, if you took away all the debt from economies, you wouldn't expect cycles. Well, now you've got enormous amount of debt, and you have to be attuned to all kinds of potential black swans to the economy itself. But when it comes to the behavior of the stock market cycles, if you will, here's what I think is really, really interesting is, as I mentioned, from 2000 to 2010, the internet bubble was a 50% drawdown. The great financial crisis was a 50% drawdown in the stock market. Absolutely devastating to those who indexed. I mean, if we had 150% drawdown, we wouldn't be in business, right? And yet people crowd into the S&P 500 without a healthy appreciation for how much risk there is, because everyone says, well, that's just what you do, right?
Yeah.
And it's come back, but it came back after the great financial crisis with a lot of stimulus globally, as we discussed. Well, in 0809, there were a whole group of folks who said, I will never get in stocks again. That decade was just too painful for them.
Yeah.
The 70s was similar, right? And
I don't know.
Well, I don't know either. We read about it. I was a kid,
Right.
and you weren't around. But the point being is that was the time to get in.
Okay.
Right. Now, all those folks came back in because there was no alternative. Rates were too low. And candidly, aside from the S&P 500, international didn't do well. Emerging markets didn't do well. Commodities didn't do well. The only things that really did well were pockets of the stock market and leveraged opportunities in real estate, et cetera, right? That reversal process, I think we're at the beginning of it.
Okay.
And our point would be, and we're voting with our wallets, as I shared, is you don't need to be afraid of the stock market, but I would say it's a bifurcated market, dominated, as we discussed, by this small subset of darlings, but there's a whole bunch of stuff that if you approach it like you're buying a business as opposed to buying a stock, you can buy cash flows cheaply that are well suited for the economic cycle that we're alluding to, because of all this debt, because of all this excess that we've just endured. And that's what we're trying to do, is be sober about where the opportunities reside and where the hype is, because we don't want to be where the hype is, or to use a cliche, we're trying to skate where the puck is going.
Yep, I've heard that one a lot.
Yeah, I know.
Finance lessons, great Wayne Gretzky.
Right.
Wonderful. Well, I want to remind everyone that we do have a question and answer applet. So just type in your questions. I'll be sure to pick them up as they come in, because we do have a little under 10 minutes left. So Larry, that's really eye-opening, and I appreciate that view on cycles, because it certainly takes some patience, and it takes a degree of mindfulness to realize where you are in a cycle and let the data speak to you, rather than letting emotions take over your decision-making process.
Can I interrupt and say something on that?
Yeah, sure. Thank you.
As you know, the vast majority of our business looks at investment managers and said, how did you do this quarter? Or how did you do this year? Right. And to us, that never ultimately works, because you're trying to game the system. You're not an investor, you're a speculator. Okay, I need to buy NVIDIA because it's going up and I think it's expensive. I'll be able to jump out. It never works. What we try to do, and we get it, people follow performance. That's why this conversation is so valuable to us. We try to be really, really candid about what we're trying to do. And for us, it starts with risk management. It starts with thinking about all the bad things that can happen.
Mhm.
And if we can keep from the bad things from happening, if we don't take the big drawdown, yeah, it might not be spectacular sometimes, but what we don't want to do is interrupt compounding,
Right.
right? So running in place last year when everyone's down, especially bonds and stocks was down,
Yep.
yeah, we're proud of that, and we think it illustrates the risk management we're doing, and we think it's going to return. But the communication, all we can do is be candid about what we do well, and people
Yeah.
need to decide if it's right for them.
How does St. James balance the prospect of a company that has good cash flows, but is also trying to, pioneer something, or, a company that is steady? Microsoft comes to mind. They're a stalwart, but they're also trying to play a lot into AI, which is an unproven thing. How does
So,
St. James balance a company that is kind of playing in both spaces?
well,
Is that company not considered?
no. So what we want our managers are good allocators of capital, right?
Yeah.
So there's a lot of dividend yield in our strategy, but we don't put it in your face because we would rather have a company that has great return on invested capital prospects. And then if they can't allocate capital well, they return it in a dividend or they return it in share buybacks. That's good management. But you brought up Microsoft was interesting. We bought it coming out of a great financial crisis, $15, $16. Everyone, we would get, people would, that it wasn't cash back then. It's like, why do you guys own Microsoft when Apple's going to rule the world? And we said, they're not even in the same business.
Yeah.
And at that time, Azure was being developed.
Mm-hmm.
And no one even knew what that was. So for us, we could look at Microsoft and say, we're paying cheap for the enterprise business. We get all this other stuff for free.
Yeah.
And then
Okay.
the worst thing that could have happened, because Ballmer was in charge, is he was going to buy something and pay too much, like Yahoo. Fortunately, he went out and telecame. Right, but it all comes down to valuation.
Okay.
So Microsoft's awesome. We would own it again at the right price, but we cannot, with our discipline,
Yeah.
we can't get there at this valuation.
Sure. Understood. We did have a couple questions come in.
Yeah.
The role of precious metals in a portfolio like that. What's the thesis behind that? Is it a portfolio hedge, or are these really attractive businesses, despite the fact that they're based on a commodity?
All of the above.
Okay.
I mean, it's amazing to us. Gold and precious metals used to be a normal allocation and now you talk about it's like bringing up politics. It's pretty unbelievable.
Really?
And as Americans, we tend to think of it as, a pet rock, which is amazing. Warren Buffett said that, but at one point he was the largest holder of silver ever. And in fact, his father, a Nebraska senator, was big about the gold standard. Here's what's happening in the world, though, that makes it so incredibly compelling. I mean, you think about all this debt coming due in the United States. I mean, 2/3 of our treasuries are going to roll over in the next 36 months. Trillions and trillions of dollars. Globally, central banks are buying gold like never before. And you say, well, what's going on? Well, on top of all the normal reasons to own a hard asset without counterparty risk, when Russia invaded Ukraine, the United States, to punish the Russians, turned off the SWIFT system that kept the Russians from getting their euro dollars. Euro dollars are not controlled by the United States Monetary Fiscal Authority. They're outside the system. They've always been looked at as an asset. Well, I'm not saying whether that's right or wrong. The point is, all the other central banks in the world said, holy cow, if I got euro dollars, the United States can take my assets. If they don't like me, I'm going to buy gold. And so the demand for gold is skyrocketing right now.
Okay.
So we look at it, and then you look at like Agnico, our second largest position.
Mm-hmm.
The assets they have are in incredibly safe jurisdictions we're buying this at, depending on the price of precious metals, 5.5 times free cash flow. I mean, you can't have a better setup, especially if you're constructive in the underlying commodity. So I hope I didn't ramble on too much, but
No,
I mean, I've got a lot more to say
some
if someone wants to
nuances,
reach out.
right? Some nuances to it that are certainly not commonly appreciated for sure. But obviously that and gold historically, is very uncorrelated to stocks. It responds to things like inflation. People flock to gold when there's a spook in the stock market. So it's certainly a diversifier for you.
Well, not only, look, mathematically, the best thing the US can do with all this debt is try to inflate it away.
Yeah.
That's, and I suspect they will. I don't know how. I've heard of it. Just, this is a hard asset that is increasingly becoming a medium of exchange and taking the petrodollar. And it's not happening overnight. I don't suspect, I'm not, but there's a lot of compelling reasons to have some.
Yeah, interesting. Okay, and we are almost at time, but I want to end on one more question that we got a little bit.
Sure.
The question is, any insights on international investing? But I'll nuance that question. And St. James is a bottom-up manager, meaning they look at the companies first and look for great companies, kind of regardless of where they are. But in your process, because you don't have just a specified universe, a discrete mall where you can go shop, you can shop anywhere. Is your process leading you to any good opportunities internationally? Are you seeing more internationally? Because
and we've done this historically. They're very large global companies. So right now we can own Unilever, right, which is European based, a lot cheaper than we can own Procter and Gamble. And yet when you look at the global revenue mix, it's not that disparate, right? Medtronic is the leader of medical devices. They're UK based. We've owned Diageo, which is a spirits leader. So we're not looking macro saying, hey, we want to have exposure to Southeast Asia or something like that. That's not our discipline. But in our universe, we're looking for great companies, great balance sheets. And just because a company is based somewhere else, they still might fulfill our criteria. And we've always had some exposure to companies based outside the US boundary.
So are you still seeing plenty of international companies show up on your filters, on your radar?
Well, I mean, we have a wish list and they're just part of it. I mean, their ADRs are easily traded. You won't, we'll have some mid caps as you own, but very unlikely would we have a mid cap that's based outside the US. It's more, are they a global leader? And we're not just going to shy away from Medtronic just because they're not based in the United States. They have enormous amount of sales in the United States.
Right. Wonderful. Well, it has been quite a discussion. We're at a little over 12:40, so I'm going to take that opportunity to say thank you very much for being here, lending St. James's expertise and experience and very unique opinion to our audience. We rely.
That was a diplomatic way of saying it, I suppose.
Well, we rely on you guys as a foundational part of our clients' portfolios. And, it's, I think by definition, has to be different and solid. We educate our clients a lot on why we own you, just like you've educated us on why you own certain compounders. So thank you very much for being here.
Thank you. You guys have been wonderful partners.
Mm-hmm.
You can relate to everyone on the call and beyond. I mean, this is our money too. And if anyone wants to reach out, we really do value every dollar we're trusted with. And if we can address any questions, we think we're proud of what we're doing. And as you can tell, we probably like talking about it too much. So Other than that, go Cowboys and,
I'm gonna mute you right
thank
now.
you again, for having me.
Yes, everyone on here, if you have any questions for us, even after the fact, please feel free to email me, email your advisor, and if we can't, I don't know, provide the clarity you're looking for, we will take the question straight to Larry and either connect you directly or we will provide the best answer we can. So thank you everyone for attending today, and everyone take care. Bye.
Thank you.